expense, right? So at that moment, if you haven't made any, like at least on the income tax terms, right? If you haven't made any profit yet, you haven't sold it yet, this is not taxable. It's taxable when you sell it for a higher price, right? If you sell it for a lower price, there won't be any taxes, at least income tax. How about this one here?
You pay.
You
Right.
pay.
So now it depends of whether you can kind of mix up the sort of higher cost that you have here with that profit. Most tax codes don't allow that. You can't kind of add up the two positions and look at the aggregate. In Germany, kind of netting between different types of incomes, for example, you can't net gains from dividends with losses in share prices. That's not feasible. It's different income. Or interest rate profits, you cannot kind of offset that with losses from selling shares. Different type of income. So in Germany, you would have to pay taxes on this here because it's a profit, it's an income. Right? And it's due immediately. Right? Because this is a one-off cash flow, an income for you, and you have to pay the taxes in the moment when you get it. Right? So this is not taxable at all. It might have taxes in the future. This is taxed immediately. And now, if you buy the oil, also the reference is different because here you're physically buying the oil at the price of 43.25, and here you're buying the oil at 50. Right? Now, consider the difference. If the oil price that you sell it for ends up to be 48, then here you would create a profit of 48 minus 43.25, which is taxable. Here you bought at 50, so you're making a loss. It's not taxable. Right? So the actual outcome for you that's relevant for the tax returns is vastly different depending on whether you have cash settlement or not. So if you want to anticipate this, in Germany you have capital gains tax of 25%, you just have to buy more of these contracts, right? Such that if you need this year to offset your losses, if you want to have a profit after tax of 6,750, you just need to buy more contracts. In this case, 1.33, right? And then minus 25% of that will give you the same cash flow after taxes. Right? So you can incorporate that into your decisions. I'm not going to elaborate on this further because it really depends on what country you're looking at, what the tax code is, and you can do whole lectures on kind of derivative and kind of financial accounting. And you have, I think, better suited professors and better classes for this than this one. Good. So when are we generally doing the losses? We're making the losses if the actual price turns out to be below the price that we have agreed, and we're making profits when it rises above. Now, there's one feature of derivatives is that they're only created if two people meet in the market, right? So if you buy something, this is your profit and loss from your positions, but there's always another person who sold it to you. And the profit and loss of the person who sells it to you is exactly the opposite of this. So if you make a profit of 6,750, it does not magically fall from the sky. It's the loss of the other person, right? It's a zero-sum game at the end, right? So if you, in the whole derivative business, you sum up all the profits and loss of everyone, it's zero, right? And that's something different than for stocks and bonds, because stocks and bonds are in positive supply. Remember, they're part of our market portfolio. Derivatives are created by two people meeting, and one seller, one buyer, and if you add up their profits, you end up with zero. I think I mentioned this briefly, that how derivatives work in the capital asset pricing model. Right? So derivatives can't be part of the market portfolio for this reason, because you need to have one person who buys it and one person who sells it at the same time. And in equilibrium, that's not feasible because everyone buys the market portfolio, so everything buys the same. So you can't have a situation where one person buys and one person sells. Right? So prices of derivatives in the capital asset pricing model are chosen in a way such that no one wants them, neither to sell them nor to buy them. Right? So they shouldn't exist in the world of the capital asset pricing model. Right? That's how they're priced. Again, we see that they're traded in the real world, that people use it to reduce their risk. They have some useful applications, but also people use it for speculation. And all that shouldn't happen if the model was actually the true, perfect model. Okay, so now if you want to put this into a graph, just put this on the x-axis and these two things on the y-axis. Right? So let's do that. I'm going to distinguish between two pictures. The profit and loss picture is usually different than this picture here. For the cash settlement, they're actually going to turn out to be the same, but usually they're not. These pictures are sometimes called payoff diagrams. So the cash flow will be sometimes just called payoff, but there's no kind of difference in the terminology. Like in German, you would say Zahlung und Auszahlung. Payoff would be Auszahlung. Right? So that's really just a tiny difference. Okay. So on the x-axis now, we have our scenarios for the oil price. So S will be used generally for the spot market price here, and the T indicates the time. So the capital T here was the maturity date. So these are going to be straight lines. So on the x-axis, we have our forward price. I think I haven't really properly explained the notation of the forward price. So F will be the price that you agree in the transaction. 0, the little 0 here, is the time when you agree on the price, so the initial starting date. And in the parentheses, you write down the maturity date, so when actually the payment is made. So I have it on the slides here, but I haven't really commented on it. Right, so the date when you agree on everything, that's little t here, and that's the date when everything is paid. And our notation for the price that you agree in is F, the forward price, little t for the time when you agree on it, and capital T for the time when it's delivered. There will be other notations that you find in books, so they typically assume that this here is t equal to 0, so they just standardize this to be times 0, and you'll find a little 0 over here. But in terms of formulas, it doesn't make a difference. I will consistently use the notation that you see here. So in our picture here, this was the 43.25. And then we have the same price here. So let's do it in green. And the first line that I draw here is the cash flow from physical delivery. Right? So we pay the forward price, so minus F01. Right? It doesn't matter where the scenario ends up because I always have to pay the agreed price. Now for cash settlement, I actually have to pay the actual profit and loss. And if we want to draw this here, the cash settlement picture looks like this. When the actual oil price happens to be below the price that we agreed, I make a loss. And here I'm above the 0, so when the future oil price is increasing, I will make a profit relatively to buying at the maturity date. So ST here will be the price or scenario of underlying asset. At the maturity date. So we're going to draw many of these pictures for options because it's much nicer to understand the cash flows from products if you put them in such a big. So payoff diagrams. This one is pretty straightforward because it's just straight lines. So whenever you see a payoff diagram with straight lines, that's an easy case. The options, unfortunately, they will be partially linear, so they will be straight lines, but they will have some kinks in it. So suddenly you have different directions, different slopes, and that creates a bit of a problem for evaluation later on. Right? But if it's just a straight line, that will be the most easy case that we can have. Now let's think a bit about what are the cash flows of the seller of the contract. So these here are the long positions, and typically I would always recommend to remember the pictures only with long positions, to just not have to memorize too much. But how can I figure out what the corresponding cash flow of the short position is?